Welcome, everyone. I'm Angelo Robles, and welcome to Family Office TV. And today, a little bit more important, and it has a meeting. You'll learn a little bit more at the end. Also, the founder and chairman at SFO Continuity. This is live and in person. We haven't done too many of these, but we have a very special guest with us today. This is going to be the story behind the Harvard Management Company, or formerly corporation, in 1974 with one of its founders, and that's my special guest today, George Siguler. To give you a little bit of context on George, he's kind of accomplished. He's the founding partner and executive chairman at Siguler Guff, an extremely expensive and expansive organization in alternative investments, and has been for many decades. He has his own single-family office, and as I kind of hinted with my title, he really is one of the founders in what we now know as the endowment model, heavily invested in alternatives. And we're going to go back to the origins of that in 1974. To give a little bit of context, not that Harvard itself needs any additional explanation, but I think to help to set the story, and there are little different variations of this, but Harvard was founded in, I believe it was 1638 by John Harvard with a donation of, I think it was 400 books and half of his estate, and the rest is history. So the endowment itself really goes back longer than any college university in the United States. But it really wasn't until 1974, many hundreds of years later, where things radically changed. And many of you, especially those of you in Boston and around finance, will know names like the Cabots, will know names like George Putnam, and now you're definitely going to know about the great work of George Siguler. George, it's a pleasure to have you with us today. Thank you.
Thank you. It's good to be here and talk about something that's near and dear to my heart, endowment management, and something I've been in and around for over 50 years now.
Of course, it's really an honor to have you here. I'm going to start with the question of, what was Harvard doing leading up to 1974?
Well, I joined Harvard to work in the treasurer's office in July 1 of 1973, which was also the start date of George Putnam, the newly named treasurer. And one of the tasks was to just look back at what we had and how things had been done. Starting in 1948, State Street Research and Management became the single manager of the Harvard Endowment.
Now, so my audience understands that's completely different than State Street, the bank and custodial firm.
That eventually merged into another larger management organization, but was truly a top quality asset management.
Indeed.
With a real history going back to the 1920s. The Harvard Endowment in 1948 was about $145 million. So from 1636 to 1948, it had built 100 to 140 some million dollars. And from 1948 to the present, it's taken that to 55 billion. So a unique time in history. But the role of the endowment was very much tied into the role of the treasurer. So Paul Cabot was the treasurer from 1948 until the 1960s. Of the then managing partner of State Street and Fund, George Bennett, succeeded him as treasurer. And then in 1973, George Putnam succeeded George Bennett.
And I'm assuming that would be George Putnam of what the audience may know of Putnam Funds.
Right, absolutely. And so the model up until then was that the treasurer, who had fiduciary responsibility for the funds, also managed the funds within his own investment organization. It worked, and Harvard was well served. Probably couldn't do it today with the notion of conflicts and the like, but it was done, I think, to a genuine fiduciary standard where they cared greatly about how well this money was managed, and basically gave it every opportunity to participate in new issues or interesting investments and the like. So all along, Harvard had been pretty well managed, but was going to be going in a different direction when George Putnam took it over.
And what led Cabot as president and Putnam, as you noted, realizing, and again, they have no one to follow that was actively involved in privates and alternatives. What led them to say, this is working, but times are changing, we need to adapt? What was the impetus?
Well, at that point in time, Harvard was about $1.2 billion in assets, which made it not much smaller than Fidelity, probably bigger than Keystone or Colonial. It was a sizable pool of capital. And so if one looked at what the management fees were by an industry standard, then they're on an NAV basis, percent basis points much higher than they are today. It was an expensive proposition to have your money managed by a financial organization. You could take the same amount of money and hire some very, very quality people to have the chance to work in an organization with obviously the worthwhile cars in Harvard, but also one where you didn't have to do the administrative marketing and other components. You could just be a person deeply into investing. The other notion was you probably could look at I had the various C's. It would be cheaper, have lower costs. You'd have greater control. You'd have people who had a deeper commitment, and you could do innovative things. The corollary to that was developed pretty quickly, that came to be known as make and buy, not make or buy, but make and buy. So as we were moving to take the money over from State Street Research, a team got hired. Walter Cabot came on as president. He had been the supervisor of all the portfolio managers at Wellington. Nils Peterson had been the head of fixed income investing at Wellington. John Chase was a senior equity portfolio manager. David L. Babson. Fred Klein was the head of research at Bank of Boston. Bob Mastrovita, head of research from Alliance. So really high quality people.
Indeed.
And then we supplemented it, and we didn't know exactly how big, but we were going to hire up to 5 firms who would manage a small portion of Harvard's assets, but have open transparency for their research, their philosophy, their trading skills, and the like. And so, coincident with the first year of putting the team together, was also a search process for figuring out who these partner organizations would be. And in the end, we picked 3 equity managers and 2 fixed income managers. We picked Brown Brothers, that had great skill in Fed watching and fiscal and monetary policy. We picked Scudder, Stevens, and Clark, which was well known for all this literally daily research on spreads between governments and agencies and the like. Lots of valuable information that didn't share to this. And on the equity side, we picked a firm called Everstat, which was a top investor in technology companies. Mackay Shield was the world pioneer in quantitative structures. And Fiduciary Trust was unique in it and had a fair amount of experience investing offshore. So those initial firms, basically, long only in equities or long only in fixed income, but there to supplement the internal team and offer other further insights. So we were leveraging off of them by paying them fees on the associated capital that they have, but obviously nothing in addition to that. So we could
their depth and intellectual resources were yours to be.
And it became a good partnership, and
mutual, of course.
And they. I think they benefited commercially from getting an assignment there. I think there were over 100 firms that submitted proposals to try and run part of Harvard's money. And 2 of us kind of went through 100 interviews. It was myself and a fellow who was a consultant to us, who was also a classmate in business school, who was well known as Jim Bailey, who subsequently founded Cambridge Associates.
Yes, I would say pretty well known.
Much of the data we had. And wisely taking that data to other colleges and universities to help them consider managers they might hire and strategies they might adopt.
I think a couple of points, George, and one, to give our audience a little bit of context, State Street Research and Management, which was doing a wonderful job, but again, times were changing. You mentioned in 1974, Harvard's endowment was about $1.2 billion. they were only charging, I guess, as part of a special agreement, $100,000 a year.
Right.
But I think the audience is going to be interested. You were young in your career, very young. Putnam is a powerful and influential figure even back then. How did you even get his attention on these issues of more diversifying the portfolio in a different perspective?
Yeah. George was a remarkable person. He was a mentor and surrogate father to me. And so, we would present with ideas, and he was very successful in building Putnam around very competent people. His greatest asset was the people he chose, and then let them have a lot of leeway to do those.
I only have to chuckle for a second, George. Those of you that follow my practice management work, which is the heart of what I do in single family offices, what do I say is the number one thing 50 years ago and today? And when we get to talk maybe a little bit in a second interview about George's incredible company that he built, it's the people. The people are the driving factor in success 50 years ago, 100 years ago, today, and I'm assuming, well, who knows with AI, but relatively in the foreseeable future. But I think the audience is going to be interested. You're young. He's accomplished. How did you even get his attention to meet with him?
Well, we met every day. He did an office at Harvard Management. And during that first year, he and I started on the same day. He had this notion that he wanted to create a vehicle, a Harvard Management company, for the reasons I said of cost, control, and commitment, and the like. And during that first year, the first hurdle was to get the Harvard Corporation, the President Fellows, the trustees, if you will, to accept the notion that there was going to be this new entity created to manage Harvard's money, because it was going to be high visibility whether we liked it or not. And it was going to solely run Harvard's money. It wasn't going to be that and then outside accounts or anything else. And so one of the early things I did was, and this was before people got hired, was visit pools of capital that were internally managed. So at that point in time, Ford Foundation then and continues to run its own money. U.S. Steel Pension Fund did that. So there were other players who had sort of pioneered that approach. I think we nuanced it a little bit, and that the people were not going to go to work for the university as university employees. They were going to be employees of a corporation that was owned by the university, but it had a board of directors, it had a charter and bylaws and the like. It had none of the pretensions or protections that universities offer. There was no implied tenure. You couldn't be terminated at will. And its compensation, which was, by historic standards, extraordinarily modest, was comparable to what a mutual fund or a bank trust department would pay at J.P. Morgan or at Pioneer, Fidelity or such. And that's how we attracted people. But it took a year to put that together. It included mundane things like finding office space or renting, buying furniture, or, I remember they were back ordered forever to get an IBM correcting selectric typewriter.
That was the thing back then.
That was the thing back then. And I had to explain to the salesman that we had 300,000 shares of IBM stock and move the order along. And we got all the stuff we needed. But people came on starting about 9 months after George Putnam became treasurer. And by July 1 of 74, then it was our responsibility.
If you don't mind me asking, what did the team look like?
As I mentioned, Walter Cabot came on as to be the head, and had real experience as portfolio manager, had run the Wellington Fund, which of course was appropriate because it was a genuine balance fund. They don't have many balance funds now where for a single vehicle you'd have both debt and equity. And Wellington had, Wellington and Vanguard were interchangeable. There was no Vanguard yet. The back office of Wellington Funds was what eventually evolved in becoming Vanguard. So Jack Bogle was around, and the group in Boston, Bob Doran and such. So, George had to sort of extricate people from organizations that were important to those organizations to put Harvard Management together. But it was a good team, and there were, people stayed and were in an environment that they wanted. So innovation, it came from the bottom up. There was no notion of, asset allocation was really around stocks, bonds, and cash. And, people sort of had a 60-40 idea, but with a lot of latitude. The increment, everything we did that was innovative was kind of incremental at the time. So, I think we were approached by an organization that sort of said, you guys ought to think about lending your securities. Up until that point in time, stock loan was just broker to broker. This was still an era where everything was in physical certificates.
Yes, exactly.
And so George Putnam said, let's pursue the idea, see what we can do there. What was New England Merchants Bank had been the Harvard custodian from about 1920 till the time we got there. And it was an inventory control basis. There was no accrual accounting. There was no double entries. It was just, here is what we think you own, and these certificates are involved in your name. And we owned our own nominee name, Crimson Co. But clearly they weren't doing what was contemporary at the time. I spent a year after business school working for what's now Ameriprise, a mutual fund company. So I was used to daily pricing and accrual accounting, and Harvard should have that as well. Kane Bank of New England wasn't capable of doing that. So we ended up moving the custody business to State Street Bank, which was then a mutual fund custodian. So they were doing daily pricing for a number of the funds based in Boston. And Harvard became a client on that standard. So we knew, again, NAV every day, and we had accrual accounting and dividend receivables and then settlement date and the like. So it became a full accounting system. We then were able to utilize that system to get into the stock loan business. And it was marginal and incremental, but it was probably at that point in time adding $5 million a year of income. On a fund that was in a little over $1 billion. So we continued that, and the mindset, particularly on the fixed income side, was more that trading would add value. That in fact, you were in a marketplace where most of fixed income was in a buy and hold mode. So anybody who could provide liquidity could really do quite well. And so we took on a strategy where we worked with Goldman and Solomon Brothers and the like to trade bonds and hopefully arbitrage out spreads and weren't warranted to be there because people were looking for liquidity and at a time when we had the capital to provide it. Shortly after we got started, other things kind of started showing up that were interesting. And I'd gone to Harvard Business School, which was, had a great finance department, but by that point in time, University of Chicago was front and center. It was also the year that Melville wrote the Random Walk, down Wall Street
book,
which basically created the framework for the efficient market theory, that markets were efficient and such. And there was just enormous empirical data to support it, that actively managed pools of capital underperform passive indices, largely because of transaction costs. But it became, it evolved to what we have today. So I started getting involved with the guys at the University of Chicago. They had, back then, it still exists today, the Center for Research in Security Prices. It was headed up by a professor named Jim Laurie. But Fisher Black was there then, Marlon Scholl.
Oh, sure.
Finishing his degree. Roger Ibbotson was there, and Rex Singfeld, Art Laffer.
Wow. Was there any pushback from Harvard? Why are we going to the University?
It was just part of equity research.
That's the right approach.
And frankly, we always had a good relationship with Harvard Business School. But there was a distance. They weren't going to time and try to tell us what to do. Virtually everybody on the team was a graduate of business school, and
Of course.
and had relations with professors they had or new professors on. I mean, I had one major research project. I had a fellow named Bill Solomon, who went on to be an associate dean years later, but he was a grad student. We worked on correlations of certain asset classes to sort of justify what we were doing. We did a major study with a professor named Bill White on spending rate, and that if you had an unchecked 5% spending rate based on a Monte Carlo simulation, you had about a 20% chance of going bankrupt.
That's not acceptable.
And so, the question was, you would never run it to that point. You would modify it along the way. But it became part of the framework of how they decided to set distribution rates off the endowment, how much the dividend would be effectively every year. So the business school was involved to that extent, and the spending rate was not established by the management company, it was established by the university. So there was a committee that included the senior fellow who was equivalent to the chairman of the board, and fellow Buxberg, who was also the head of Roche and Gray. Derek Bach, the president, was on it. Otto Eckstein, famous economist, and Bill White was on it. George Putnam was on it. And they would determine a year in advance the dividend would be going up 3% or 2%, or in a bad year it was going to be held flat.
Right.
And that's what the DDs could do with their budget on. So that the responsibility for that was not in the management company. The management company was basically within prudent risk, maximize the returns, and that was the sole mission.
And George, thinking back to 1974, and yes, I'm kind of old enough to remember, I'm thinking of the oil embargo, I'm thinking of coming right out of the Vietnam War. There was bifurcation, which we're going through now, but certainly back then in the country, those were challenging economic times.
John Chase, to his credit, was very early understanding once OPEC hit what was happening. And I think we rode out the next 5 or 6 years post-OPEC with at least a twice allocation to energy over and above the market.
Wow.
So we had that in the first 5 or 6 years, about 200 basis points of equity alpha every year. It was, that's really
tremendous.
It was a really attractive number. And it's interesting to look back because we had major oil companies, but we had George Mitchell had Mitchell Energy, which was
of course
fracking.
Yeah, he's the godfather of fracking.
So it was. I remember.
I think that's the George and Cynthia Mitchell Foundation, which does great work around the world.
But him coming in and talking about drilling a hole deep and then sending dynamite down there, blowing up, and a lot more oil came out. But it worked, and it was an interesting time. So we did do those things. On sort of more exotic things, it came slowly because we were willing to tip our toe and the like. And so through a network of relationships, there was an area that I had some interest in, and it was risk arbitrage. It was an arcane part of the investment world. There wasn't a lot of money allocated to it. Back then, major Wall Street firms had very little capital. I don't know, Goldman Sachs, a couple $100 million of partners' money and whatever. So
yeah,
whenever there was a prop opportunity, that was really pretty small. But we continued and then to have transactions with companies being taken over. This was right around, but slightly prior to infamous Ivan Boesky and trading inside information and Martin Siegel. But we ended up with 3 or 4 different ways we connected to Allen Company. Allen Company, for their own account, did risk arbitrage. And so we set up the first hedge fund and endowment invested in the 1977 or 78 to do risk arbitrage. And unleveraged, and it produced 20% returns annually for the next 20 years. It was an inefficient to exploit. And so that got us into arbitrage. The trading on the equity desk was able to build small positions in convertible arbitrage,
Right.
where you obviously buy the bond that has a yield, you short the stock that doesn't, then you take the difference out. And we began doing that, and we were able to get that book up to about $100 million at one time. So that was adding again another 4 or 5% net to the returns. And then the CBOE opened up, Chicago Board of Options Exchange, and that was an interesting time because Fisher Black and Myron Scholes ended up on consulting contracts with DLJ. And that's really where the Black-Scholes model was done. Inside, I mean, they were academically connected, but they were also working on the guy named Mike Glenstein at DLJ. And the options market was profoundly inefficient. I mean, it was a gambler's market and such. And so there were things you could do. Didn't have great liquidity, but what liquidity you had, you could do a conversion, which was if you buy a stock and you sell a call 3 months out and you buy a put 3 months out,
right.
You've got a short-term piece of paper, 90-day paper, but you could do that trade for a 45 and 50% annualized yield. And you could do the opposite. You can short a stock, buy a call and sell a put, and borrow money at a negative cost of money. And so as those opportunities avail themselves, our trading desk would do it. And that was kind of easy money to be found. There also were, and as much as the Fisher Black believed in inefficient markets, there were inexplicable things like closed-end fund discounts. Didn't make any economic sense. They made marketing sense because nobody was pushing them, so there was no incentive on a broker to sell them. But they were there, and you could buy something at 25, 30% discount to its fair value. Just hold on to it and have it part of your portfolio, and eventually you would increase your returns, dividends, and the like by the effect of the discount. So that was an interesting thing to do.
Those were incredible strategies.
So that took us into the trading side, and it was measured, and it wasn't particularly risky. It was just really the willingness to execute, and the marginal benefits were such that you would be very happy to do that with your paid employees, but it wouldn't be very profitable if you had to pay a 75 basis point management fee.
Right.
And so the fact that you do it internally was just another factor why the numbers worked for us.
Is that in today's world moving a little forward? That seems rarer among the endowments by far.
Yeah, I mean, I think that there is still a stock loan business out there. It's much, much larger, but it's a very narrow spread. And the options markets inefficiencies are largely arbed out. And even trading inefficiencies, I mean, it's what you have with major houses doing now, and where order flow goes. Again, it's hard to arb against it. But the next phase came a year or two later, and it was really the then new senior fellow on the board. Board member was a fellow named Bob Stone, historic figure in the history of Harvard. Was the original Stone and Webster family, Hayden Stone family, and such. And Bob was once recognized as being simultaneously on the board of 11 Fortune 500 companies.
It's incredible.
He was extraordinary, and he was also Commodore of the New York Yacht Club and the head of the America's Cup races, and rather
How did he have this time?
He was just remarkable. And the little infant venture industry was starting, and he had gotten involved with it. There's people he knew. And he was the one, strange things, George, go look at doing this. He introduced me to a fellow who had a little fund out in California named Tom Perkins.
He became kind of famous.
That was Klein Perkins. I mean, the first fund was $15 million or so.
Incredible.
He also has been an investor with following Tommy Davis, who was Mayfield.
Sure.
And by then, Greylock had been founded, and they were literally right across the street from us in the adjacent office building. And Peter Brook was working at a subsidiary of Tucker Anthony that subsequently called TA. And so we did a study on venture capital, and it went back to Jenny Dorio and American Research and Development and the like, and decided to make some allocations. And then I think Greylock was raising $12 million. Up until then, the money only come from families. And I think Harvard was allowed to put in $4 million.
And that's like another launch.
So it was, and it was good for us because they were smart guys doing interesting things. It was good for them because they could walk around saying, we've got Harvard's money, we're going to invest in your little startup. This is going to give you added credibility in the market for customers or employees or the like. That there must be something here because Harvard did it at that point in time. We were totally relying on them. But that started, that program effectively continues to this day in terms of investing in venture capital. Came a year or two later, we had hired a fellow. We were doing all this trading and options and stock lending. Like our back office was overwhelmed, and we hired a fellow named Don Bean, who was the treasurer of Morgan Stanley, to come run the back office, which was great, and he's really great at it. But his real contributions, he went to Columbia Business School and Henry Kravitz. And Henry Kravitz and Jerry Colbert and George Roberts had left Bear Stearns involuntarily because the firm didn't want to pursue these bootstrap transactions. And so they were looking to raise their first fund. So I think it was $200 million. And because of Don Bean, we were 15 of that.
Wow.
So
that's the early stages of KKR. That's amazing.
Their first institutional fund. So it was it built from there, and we continued, and obviously it became an ever larger part. But there was never a notion, geez, we're going to stop at 20% and 30% or the like. It was still small to the total, and the real alpha, the early years was driven by that large position in energy, that environment. And fixed income, we suffered through that. I mean, we started in 74, and, we had the great malaise of Jimmy Carter and inflation, and then Paul Volcker in the early 80s, taking 30-year governments to 16%.
Yeah.
Really clobbered the bonds and such. And so we rode that down and rode it back up. But, it's interesting, and you look at how things have evolved. And I went back and looked at Harvard's performance in 1948 forward. But if you look back and take 1929, the Depression, from 1929 to the summer of '82,
stock market.
the Dow Jones doubled. 53 years, it doubled. If you break it from the summer of '82 till now, 42 years, 50x.
50x.
From under 800 to right at the edge of 40,000 in 42 years. So which one is real? I don't know. But it's been
They both can be. And a lot of people forget that 40 plus period where it was horrific. There's no guarantee that won't happen again. There's lots of dynamics around that. I'm doing several interviews with George today, so most of you will have an opportunity in terms of enjoying them, but I did want to bifurcate them because I think with the Harvard Management Company, effectively the Harvard Endowment and George's role, which was incredible, as you're finding out in terms of that he did there, I think it was important. I have two more questions on the endowment, and then we'll personally take a little bit of a break and transition to the other conversation, which, to give a little bit of a hint, by the way, in looking at George over the years, we're talking to someone who has invested in over 900 private companies. So you could bet you, given that I have a holding company, that I'm active as a direct investor, that I have a lot of questions for George on that. But in wrapping up on the endowment, and a comment, you mentioned it earlier, the Harvard Endowment is $55 billion. To give you some context, that's larger than the GDP of over 120 countries. And of course, it grows and is distributed tax-free. It's really incredible. My final two questions, you hinted at the answer on the first one, but we'll dive just a little deeper. How has the endowment model of investing changed over the last 50 years?
Lots more people playing it. So it becomes a standard, if you will. People build their portfolios off of asset allocation models,
Including family offices. Yes.
and so when we go in to talk to a prospective client, we'll learn what their asset allocation is and how it's governed. There's a lot more advice and expertise and the like, but there's also a lot more competition. So the creation of wealth in inefficient markets is just so much easier. And now we're in a market where there are 7,000 competing private equity firms out there, and so and most deals are won by auction, and nobody ever wins an auction with the lowest bid, so you're paying full price. But the capital markets are working, and endowments have raised enormous amounts of money. At one time, Harvard was, when it was $1.2 billion, was about 10% of all endowment money. But this last 50 years has been remarkable. State universities have virtually no endowments, and now you look at the Virginias and Michigans and Berkeleys and the like, and so generous alumni have done. And for all the current contemporary issues of what's going on campuses and the like, our higher education system is so much better than anywhere else in the world. And the fact that we have private institutions that have these kinds of resources to pursue all kinds of areas of new knowledge and technology doesn't exist elsewhere. And so, we have to sort of grin and bear it when we say, why are they behaving this way? But inside these institutions, there's something that no other country in the world can do.
And perhaps my final question on Harvard management and effectively endowment investing. In your opinion, what are the most significant challenges facing the endowment asset allocation strategies today, and how could they be addressed?
I think that the future of capital markets and the returns generated are less predictable now. People suffer from fighting the last battle. And we're going to go through a rough period of time here on venture capital, which is a big part of this strategy, just because there are very, very few exits. There's no IPO market. Those who've done it before, and I sort of agree, it's a cyclical business. But as an investor, where I've had pieces of Google and Facebook as private companies. I'm hard pressed to see how those things are coming through the system now. And it's when you slow down the process, we know that 50% more of venture-backed companies are not going to make it. Some of them make it to an IPO and then they don't make it. But as that gets elongated, some of them are just not going to make it without any chance of an exit. So I think that's something that we kind of need to worry about. But no, I think that the investment teams at major universities are really high quality. People strive for those jobs, and the quality of due diligence they do is certainly better than that.
Okay, that does bring up now the final question on the subject, because it sparked in my mind. I'm a single family office person. I enjoy endowments, institutional investors. I have friends in the community, and I've even done some work relative to crossing over people that are CIOs from institutions to family offices. Institutions have significant tax advantages, endowments specifically, over family offices. There's an approach that many endowments are doing now that are incredibly very diversified. I could argue that could perhaps hinder returns, but they may have a hurdle rate, they meet it, they're happy, they don't have tax implications. Families or single-family offices have to worry about all of that. There's competition for talent, although single-family offices compared to pensions and others could pay more money for the right talent in a CIO role. They Is the endowment model of investing the right model for most billion-dollar family offices, or should they be more concentrated?
It's hard because taxes are such an overwhelming part of it.
Yes.
And so, everything you do needs to go in that side. I mean, and you look at, the last tax bill that basically made non-deductible management fees from the advisors,
Yes.
which was extraordinarily painful. And when you think about what percentage it was taking, particularly in hedge funds. So yes, the endowments have that advantage. I think that family offices need to have longer duration assets and defer realizations with things that are compounding internally. I mean, you could talk about the endowment foundation model. You should almost be talking about the Buffett Berkshire Hathaway model.
We're getting to that in my second interview with George.
The notion that you have an internal rate of return that you're not distributing it. I once said, that Buffett's greatest asset was the fact that he wasn't challenged to be part of the investment company act where he'd have to pay annual dividends. He used insurance holding company structure that allowed him to never pay a dividend, which obviously created a huge amount of compounding. Einstein did say the greatest invention of mankind was compound interest. And he sort of, I think that, again, family offices need to find things that are longer duration, less current income oriented, and then, how they can, who they can hold and use for counsel or advice or whatever, put those things together. I have the luxury in my family office to look at the products I have here. They're equity oriented for the most part, and so I have some of that benefit. But we're turning and selling companies over 3 or 4 year holding periods, where actually I can be personally benefited by holding them longer.
Oh, we're going to get to all of that in what I'm calling my second interview. On that note, in wrapping up this interview, and I know given George is going to be a popular draw, there's lots of new people, perhaps from the endowment and institutional world, that are dying to hear the interview, like, who's the guy with the beard? I have no idea who he is. And I don't blame you. And by the way, I'm Angelo Robles. I'm most known in the family office community as being the founder and effectively near 2 decades CEO at Family Office Association. I was fortunate to have a successful exit a little over a year ago. I didn't retire. I took a little time off to travel to Europe, to go to Wyoming. I created a family office and a holding company. I do love interviews, so creating Family Office TV has been a labor of love. So I hope you're all enjoying that. And I did promise I would come back to this. I mean, I love getting incredible people together, especially that are wonderful people and great investors. So for me, forming a private club called SFO Continuity, for those of you that don't know, SFO would stand for Single Family Office, effectively 30 founding members that have an opportunity for me to share my research, my content, but more importantly, that's a sidebar, to get together both digitally and in person, effectively beginning now, late spring of 2024, once a month. So I kind of make New York my home from, let's call it May through October, and Palm Beach, our hub as an organization, November through April, and the opportunity to be a part of something where incredibly talented people like George, and I'm very fortunate that George himself is a founding member. So being part of a special club that is private, that is exclusive, where you're learning and sharing peer ideas, I think is the most important thing in a community, and really my passion in building SFO Continuity. Couple of more spots for founding members for those of you that are interested. And it may not be the most comprehensive, I keep it that way, but everything is on my website, which is my name, and that's my brand, angelorobles.com. So check us out, follow us on social media. I'm very active on LinkedIn, on YouTube, Family Office TV. There will be links from my website, again, angelorobles.com, and learn more. I look forward to it. George, it really is an honor to interview you. This has been incredible. I learned so much, and we're always honored to have you.
Great. Thank you very much.
My pleasure. Thank you.